Hi, everyone. This is Jason Bierko of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years. He's worked in banking and the financial industry out of England and London for many decades. He also has the popular Mineko64 YouTube channel. Mario Ineko, thank you for joining me.
You're welcome, Jason. Nice speaking with you for the first time.
So we're recording this interview on Monday, December 18th, 2023. The gold prices in US dollars are kind of in a trading range around $2,027. Silver's under $24, $23.81. I want to get your before I get your thoughts though on gold derivatives, bullion banking, because I know you've been working in the banking sector for decades. I want to ask about your background first. You worked in London for a long time, right? So you're not from England. I don't hear a British accent. So maybe tell your story about how you started working in banking and in London and England and the financial industry there.
Yeah, my accent, I guess people think I'm either American or Canadian, but I'm originally from Brazil, but I went to school in Switzerland and also to university in the States in Florida. I finished university actually in Switzerland because my parents moved there in the 80s. So that's where my accent comes from. Yeah, and I'm not British, as you can tell. But yeah, I started in the city in 1992. Prior to that, I got a job at a small private bank in Geneva, Switzerland, for about 3 years. And someone approached me to go and work in the city of London, actually in the U.S. Treasury market, being a salesman for institutional clients in the treasury market at Cantor Fitzgerald, actually. And then that didn't work out working there because whatever happened, they didn't want to give me the registered rep training that I needed to speak to clients. They wanted to keep me in the back office, so I decided to move, and then I got into the futures market, doing government bonds as well, treasuries, bunds, and yeah. So as a futures and options broker for like 20 years up until 2012. Prior to that, though, in 2002, I started buying physical gold. I started buying Krugerrands as a way of diversifying away from the stock market after the dot-com bubble burst. And once you buy a gold coin or a few gold coins and you hold it, it's really special. So I really started looking into things, into the history of gold and the monetary system, the Austrian school. And I became kind of obsessed with that, and I don't mean it in a bad way because you need to be obsessed with the subject if you want to really learn about it. And ever since then, I've been looking into these things. I stayed in the city, as you heard earlier, until 2012, and after that, I've tried a few different things. And in late 2015, I thought that I'd start making videos on YouTube about the financial markets, the dangers of fiat currency, the dangers of derivatives, the you know, the soundness of gold and silver as money, and the fact that fiat currency is really they all go to zero eventually. And I also try to make it interesting in that I was trying to tell the public, talk to the public as if I was talking to one of my clients. And my clients they're not retail or private clients. They were like institutional clients, if you want to call it that. They used to work for banks, hedge funds, mutual funds, corporate treasuries. And I think the people appreciate that because a lot of times they hear things and they don't know what it means. And that's what I try to clarify to people. What are derivatives? What's the yield curve? What's the flattening yield curve mean? Or all that kind of stuff. And when I started doing my videos, I didn't expect it to be here, 8 years later, with almost 100,000 subscribers and a big following. And it's nice though, and it's turned out Quite interesting.
For listeners who are not aware, a very large percentage of the United Kingdom, England's economy is based on banking and the things tied around it, right? And that's become more so in the last, I don't know, 3, 4, 5 decades compared to the past.
Yeah, I mean, even before 3 or 4 or 5 decades, when Britain had the empire and sterling was the major reserve currency up until like 1954. And a lot of people think it's 1944 when the Bretton Woods was created, but I've looked at a chart and saw that sterling only lost the percentage basis in terms of the most widely held currency in 1954 to the dollar. So it took about 10 years. But yeah, I mean, London, even before World War One, it was the center of trading and investment for the whole world. It's where the finances of British Empire went through. So it's had a huge history of finance. Yes, after World War II, it went into decline, and it was only in the 80s and 90s that it came back. And in the 80s, it was under something called the Big Bang, which was some the financial reforms that Margaret Thatcher, the prime minister, then brought into the city. And what that meant is that a lot of foreign banks came to London. A lot of the old merchant banks were taken over by the big investment banks and commercial banks. And there's a lot of consolidation. And a lot of people wanted to do business in London, not just British corporations, but people from all around the world. So yeah, it became also the hub, as we were speaking before the interview, for financial derivatives, and it still is, I would say, the biggest market for the foreign exchange market, London. A lot of the foreign exchange trading goes through London. So yeah, that's the history. And for the UK, yes, it's a very important sector, the financial sector. I would say that's probably the most important one. And domestically, though, the real estate market, or property as they call it here, is very big, especially residential. Um, a lot of times, they say that the dinner party chat is always about, oh, how how's your house price done and things like that. So yeah, we're heavily dependent on finance, even though back in the Victorian times and early 1900s, Britain was a manufacturing powerhouse. But the inflation we've had since the end of World War One and World War Two, that's killed off the real economy, and we become financialized. And unfortunately, I think that's the way I think the United States is going as well, from an industrial manufacturing powerhouse into a financialized economy.
Yeah, I agree. There's a lot of similarities. Financialization, paper instead of producing goods and services, commodities, actual manufacturing, value added stuff. This is typical end of empire waste, fraud, corruption, and abuse. We saw it with the British Empire too, with welfare and warfare state, and in all these rules, regulations, red tape that prevented new products and services. Really, post World War One. You brought up some of the financial engineering and innovation. I mean, there's accounting fraud and gimmickry at a lot of the London banks, but there has been innovation there. So there was the London. A lot of people have heard of LIBOR. They don't know what it actually stands for. It's the London Interbank Operating Rate. You have the LBMA, which is the London Bullion Metals Association. I believe the Eurodollar also started in London post World War II, which is where they created these private companies and private banks started loaning dollars. They started creating with their own ledger. So they didn't have the Federal Reserve backing, and then the market was created initially on its own, tiny, and now it's gotten to what, tens of trillions of dollars of
Yeah.
offshore dollar lending.
Well, I mean, the LIBOR and Eurodollars are one and the same. LIBOR is the London Interbank offered rate, where there's LIBID as well, and London Interbank bid rate. And Eurodollars are actually, they were created via the Federal Reserve and the U.S. Treasury. They're just dollars that flowed outside of the US through the Marshall Plan and also through all the trade current account and trade deficits that the US has been running since the 60s. So that's where all those dollars that are called Eurodollars have come from. I think there's kind of this idea that it was created offshore, but it wasn't. I mean, they might leverage it offshore here, but if you look at a lot of the euro dollars, they derive from the American banks in London or maybe in Paris or Frankfurt. And, they might get $1 billion, let's say, that Germany was running as a surplus at JP Morgan Frankfurt. They'll take that $1 billion and lend it 9 times over to let's say US corporations that want to start operating in Germany or in the rest of Europe. And because there's not just a Eurodollar market, there's also used to be Euro sterling or Euro mark. So these are just fiat currencies that are floating outside their jurisdiction, mainly because of surpluses and trade surpluses and current account surpluses or deficits. And yes, they're borrowed and lent offshore. So it's not just the dollar that was created, or I don't even think it was basically created offshore because only the U.S. Treasury and the U.S. banking system are allowed really to issue dollars. That's the way it is. Only UK banks can issue sterling balances. So I think that's a fallacy that to say that the euro dollars were created outside the US. They might have been outside of the US, but it was originally US banks that created.
That's interesting because there's a lot of Eurodollar YouTube channels and Eurodollar experts going around talking about how all these foreign European banks, so like Deutsche Bank and German banks and French banks and
Yeah.
British
Well,
banks,
they
all
they they borrowed from the US banks though. Deutsche Bank to deal in dollars, they have to have a dollar account with the New York Fed or with JP Morgan Frankfurt, and JP Morgan Frankfurt will have a dollar account with the New York Fed. I've seen a lot of these Eurodollar YouTube channels, and I think they've got it wrong. I might be wrong, but you know, uh, that's the way I see it.
well, one of them is also saying that there is no inflation for decades. So, I mean, in the system that we have, Mario, especially since 2008, I mean, all there is, in my opinion, is bailouts, currency debasement. I call it
Yeah.
stagflate tax lie. I mean, the Cantillon effect, there's just been tons of hidden bailouts and inflating asset prices since 2008.
Well, and not only 2008, but you look at 1971 when Nixon detached the dollar from gold temporarily. uh, you look at all the charts since the early 70s, they all go parabolic. Or in the case of the trade or current account deficit, they drop massively because there's no anchor. So to say there hasn't been inflation, um, you know, they in my opinion, they don't know what inflation is. The way I see inflation is the increase in the amount of currency and credit out of thin air, not backed by gold or silver.
Yeah, I mean, there's been a lot of currency debasement, all these fiat currencies, but things, my point though, with 2008, things just went absolutely haywire.
Oh yeah.
Haywire. Yeah,
Oh yeah,
my
of course.
my opinion, I think the system totally collapsed in 2008, and I think there was literally derivative failures. I think the banks were like insolvent. I think they changed the accounting rules to make the banks look
Oh yeah.
solvent. A lot of these American banks, like their derivatives positions and European ones, like they never recovered. So there's like there's no mark to market accounting. And we were talking about this before we started recording. The banks don't even have to show all their derivatives on the balance sheet.
Yeah, and I remember in 07, 08, I think Tim Geithner, he was the at the time president of the New York Fed because before he became US Treasury Secretary. And at the time I was working in the markets, and there was talk that a lot of the old over-the-counter derivatives, which are not traded on an exchange, and those are the worst because there's no accountability. You have no idea how much people have bet, And there's talk that they're going, combing through all these contracts of the major Wall Street banks because they couldn't match anything. It was a huge mess. So yeah, derivatives were the major cause of the '08 crisis, especially the credit default swaps, the mortgage-backed securities, all those things. And it wasn't a problem that Main Street was going bust. It was Wall Street. As your channel says, Wall Street for Main Street. Main Street didn't have a problem. It was Wall Street that bankrupted itself. And unfortunately, the American, well, not just American, but the British taxpayer, European taxpayers, they had to bail out all these too big to fail, which are run by the Bank for International Settlements, who changed after that. They changed the accounting rules of derivatives to make it look like there was not as much derivatives. I think it went from being a quadrillion or 1,000 trillion, and they said, "Oh, we're going to mark them to model," which basically means we're going to allow the banks to just, market, not mark to market, but mark to whatever they want. And that dropped the notional amount to 600 billion. But they're
Oh, you mean
just
trillion? 600 trillion instead of a quadrillion?
yeah, sorry, a trillion. From a quadrillion to 600 trillion. It's weird, isn't it? All these big numbers. You're not used to talking about these things. And I think nothing was solved. It was just they kicked the can down the road. And then in 2019, uh, August, September time, it flared up again in the repo market, which is basically where financial institutions lend to each other. It wasn't an unsecured, it was secured by treasuries, but they didn't trust each other that the repo rate went from around 2% to 10. And I think that was all to do with derivatives. All the problems are to do a lot with derivatives. And then they used the crisis in 2020, the health crisis, so to speak, to really, yeah, they couldn't come out and say we need to bail out the banks again. So it was for something else, right? And that's what I believe. People might not agree with me.
Oh, I
And
agree. I think the
yeah,
repo crisis, that back to your point there. So the repo crisis, the 2019 one, that was 6 to 8 months before the pandemic started in early 2020. I think the repo crisis was way larger than they'll admit in public.
oh yeah, and they used the panic and the you know the they scared people about what was happening in 2020, and that was an excuse to to print. I think the Fed's balance sheet went from just below 4 trillion, and they at the time, if you remember well, before the repo crisis, they were tapering. They'd gone from just above 4 trillion to around just below trillion, like 3.5 trillion balance sheet. And then they had to start supporting the repo market. And they started doing QE again, but they called it not QE. And eventually in March 2020, and then into 2021, they ramped up the balance sheet all the way up to almost 10 trillion. It was just under 9 trillion. And now they're tapering it back down, but they've added another 130 or 40 billion with this BTFP to help the banks stay liquid. And you were telling me before the interview that that you've heard from people in the industry that they're doing a lot of stuff off balance sheet to keep the bond market, treasury market from imploding. I don't think they will succeed.
Well, I don't think the problem is DC's running these budget deficits around 2 trillion, give or take, according to estimates. There's just not the foreign demand for treasuries now. So the non-G7 central banks are not buying treasuries at anywhere near the pace. Actually, they're net sellers, a lot of them, and they're buying gold tonnage. So the demand for the treasuries that DC wants to sell is not there. So who's going to be the buyer?
Yeah, well, that's right. And, it's not even that these BRICS plus countries want to punish the US. They just want to protect themselves. and they want to have an alternative. I mean, China will still have to have some dollars to trade with the US, but what they don't want to have to do is to trade with Saudi Arabia or other countries in dollars. Why, it's like why would the US need to trade with Mexico in euros? It's the same kind of scenario. And I know I agree with you. The deficits are going out of control. They're running deficits as if we were in a constant recession, which I guess if you take away the government budget deficit, we would be in a recession because government spending is part of the GDP equation. But if we were to have a sharp recession next year, which is what quite a few people think, can you imagine that budget deficit could go through the 3 trillion that we saw during COVID? Who's not to say they're not gonna be running $5 trillion deficits?
And they're counting in the jobs reports. They're counting the largest creation in the last 12 months, excuse me, of jobs is actually from the government. So that's counted positively. So government spending on GDP is counted positively, and then government employee jobs the last 12 months, that's counted positively in the jobs report. So I would argue that those should be subtracted.
Of course, I mean, government doesn't create any jobs or any wealth. It has to extract wealth from the private sector. So yeah, it's a fake, fake economy. It's like a Potemkin village kind of economy, I would say.
So do you think then that the governments and central banks, will they actually allow deflation for a long period of time? Or do you think post 2008, basically they decided that they can't allow deflation for a long period of time anymore?
Well, I think it's been going on for a while. I would say even if you go back to 1987 when Greenspan, just after he took over as Fed chairman, there was the stock market crash in October and he bailed the system out, and you've had the Greenspan put since then. Now people are saying that Powell is going to get rid of that put, but in a fiat currency system, uh, if you allow the debt to collapse and to correct, you destroy the currency, and you destroy the currency, you're going to have hundreds of millions of people throughout the Western world going hungry and rioting. So unless there's a major crisis, engineered crisis, and I don't know what it will be or could be, but I think when it happens, we will know that it was engineered. So it will give them a cover to basically shut everything down and make sure that yeah, they probably print more money and keep us locked down again so it doesn't create too much inflation while we're locked down or something. I don't know, but yeah, I don't see them. They did deflate, in the classical sense. M2 and M1 have come off in the last 18 months in the US. But if you look at M1 and M2, they're still well above where they were prior to 2020. So yeah, we're still. So if they do come next year and start cutting as the FOMC announcement said, that they expect at least 3 cuts, then it means they're going to inflate again, and they didn't even let things deflate back to where they were. So that's how I see it.
Well, the government needs the tax receipts from the economy not being in a recession and also asset prices being inflated. The U.S. federal government here and state and local governments for real estate, they need higher tax receipts for stocks and real estate especially. But for deflation, I know you study Austrian school economics. I see you posting this on your Twitter all the time, the quotes from classical liberal economists, even predating Karl Menger. But the free market produces beneficial deflation. It's the governments and the central banks with the current system we have, especially with the fractional reserve banking, debt-based fiat currencies, and in the derivatives, they really can't allow deflation because then you start to see banks fail. Look what happened with Credit Suisse earlier this year, right? So we had almost a derivatives failure with Credit Suisse. They covered it up, and then we see the press release from the Swiss government, the Swiss central bank, that for Credit Suisse to get bought, they had to guarantee all those interest rate swap derivatives.
That's right. You know, yeah, it was Credit Suisse. UBS had to get 100 billion francs, I think, backing from the Swiss taxpayer. And yeah, and also in March you had the bank failures in the US. That was more to do, I guess, with the value of treasuries. But yeah, and they had to like stop that though. I mean, Janet Yellen bailed out people who had more than 250,000 because she didn't want, people taking all their funds out of all the banks, and that's created a little bit of moral hazard. But yeah, derivatives, I have a playlist for just derivatives. I've spoken about it for many years because I worked in the derivatives market, futures and options, which is exchange traded derivatives, which is more transparent because you know how many contracts are traded. It's publicly announced every week. But the kind of derivative that's really bad is the over the counter because it's like me calling you and making a bet with you, and no one else knows. And
Is
it's
that
the
what all bullion, sorry to interrupt you, is that what all bullion banking is? So like these gold leases and gold swaps that we hear a lot of people talking about gold price and silver price manipulation, is that what it is? And it's over the counter and it's non-transparent?
Well, I think it's a little bit of a mixture because you have the COMEX gold futures that's traded on the exchange. But yes, there is they call it the swap market in London, the bull, and they trade paper gold over the counter. I remember the last place I worked, I still worked, doing financial futures on exchanges, but there's another desk. These guys, they were trading gold, not futures. They were trading like, yeah, over the counter. You know, let's say uh, some institution will call JP Morgan bullion desk and ask them, where can you sell me 2,500 call in gold expiring in June, next year, and they'll write them an option for that. Or, where can I buy gold? Not physical gold, but, where will you swap gold? And so that I'm long and you're short. And that's all it is. And it's not real gold. And they can't, the people who trade in these markets, they never really deal in the physical. It's just betting. And a lot of it is leveraged. If you control, let's say, $1 million of gold, paper gold, you only have to put down, let's say, 50,000. So you can see how it creates the volatility as well, which I think that's one of the big parts of that keeps people scared about gold. They think it's very volatile, but it's all because of this leverage. But I saw someone publish a few weeks ago that I'm not too familiar with the Sharpe ratio, but it's a measure of volatility and return. And in the last 5 years, gold has been one of the best in the top three in terms of having the least volatility and the best returns. But the mainstream press, they always they report on gold as if it was like a risky commodity, and you and I know that it's real money and it's really a currency.
Yeah, it's the it's actual physical money. You pull it out of the system. It's a diversifier. It's portfolio
Yeah,
insurance.
and like the foreign exchange market, that's the biggest market in the world, really. It's traded a lot of it in London is trillions of dollars a day. And I remember when I started out in Switzerland, we did a lot of foreign exchange, and the dealer at my small private bank, he had a Reuters screen with the foreign exchange page. It was called FX, and it had the major, foreign exchange pairs. And at the bottom, it had XAU and then XAG. And I asked him, what are those? And he said, well, that's gold and silver. So gold and silver are traded, the bullion banks trade gold and silver in the foreign exchange market, which is something they don't tell you. So there you go.
So for listeners out there, there's actually a great piece that British economist Peter Warburton put out in 2001 about how all these derivatives that were created for commodities were used to manipulate and control derivative prices. So they didn't reflect all the inflation that governments and central banks have created over the decades. Do you agree with him there, since you've actually been involved in the derivatives market and trading?
Yeah, definitely. I mean, commodities, as we spoke before we started recording. I mean, you go back to the 1600s, the Dutch, they traded options on tulips. And then in the 19th century, in the Midwest and Chicago specifically, they were trading futures on agricultural commodities. Chicago is the hub for agricultural goods, and that was understandable because farmers and producers wanted to you know set their prices to hedge against Mother Nature and other things. But with the dissolution, so to speak, of the Bretton Woods system, and a system that was had a bit of a gold backing. And I say a bit because the Americans started abusing that in the 60s and 70s. With the dissolution of that on August 15th, 1971, the world's reserve currency became a fiat currency for the first time in history. And that creates a lot of volatility especially in the foreign exchange market. And the foreign exchange market is where they trade money, basically, or currency, and currency is at the base of all other investments. So if you're going to have a lot of volatility in the currencies, you're going to, the derivatives will help you hedge that. And that's why, if you go back to the 70s, the first financial futures contract, if I'm not mistaken, were foreign exchange contracts on the CME. And then it evolved to interest rates and then government bonds. And then it just mushroomed. And it does help. It does help maintain stability in a system that is totally unanchored. And that's why it's grown so much, all these derivatives and interest rates derivatives. They're two-thirds of all the derivatives, and we we don't even know how much there is in notional amount. It's probably over 1,000 quadrillion for sure. And yeah, even the Federal Reserve, I've heard that uh, they use derivatives. For example, if I've heard that they've used they'll sell options on the VIX to keep the VIX, the volatility down so that the stock market doesn't go down. So they'll sell puts, or they will intervene in the TIPS market, the inflation protected treasuries, and to make it seem that to manage what they call inflation expectations. So yeah, it's a whole, yeah, it's financial alchemy to the nth power, and derivatives are at the heart of it.
Yeah, I agree. And the banks also get away with a lot in derivatives. They actually created, I believe, gold and silver futures contracts before Americans were allowed to buy gold and silver again. Because remember, I think what FDR in 1934 to what 1974, I think Americans were only allowed to buy religious gold. They weren't allowed to buy gold coins and bars. It was illegal. And then in 1971, like you said, Nixon closed the gold window. Well, the bankers here in the US and Europe, they started installing gold and silver futures contracts before Americans were actually allowed to buy gold again.
Yeah, I think silver futures actually they were traded even in the 30s. They were traded throughout. So silver futures have always been around. But yeah, FDR banned monetary gold in 1933. I think Americans could buy gold, but they had to be numismatic. And I think some of them actually, some got away with buying like gold sovereigns from the UK. They were considered numismatics. So there were ways around it, but not many people knew about it. Yeah. So on January 1st, 1975, Americans were able to it was legalized again to have gold. But the gold futures contract on COMEX, the code phrase GC, It started trading on December 31st, 1974. So, because it settles one day later. So they started trading it the day before. And there are WikiLeaks documents from 1974 where I think the US Treasury or the State Department, one of the two, were in contact with bullion dealers in London, to talk about this new event, the fact that Americans are going to be able to buy gold. They were concerned that Americans would rush to buy physical gold. But then one of the dealers said, "Oh, I think you've done the right thing to institute a futures market because it's going to make gold very speculative, and people are going to go away. They'll focus on trading gold and not buying physical gold." And I think they've been fairly successful, at keeping the general public from buying physical gold because most people just they trade gold to make fiat dollars through the futures. Hopefully that that's changing. That's one of the things I try to tell people, that they should buy physical and not futures. You might want to trade the futures, but if you really believe in sound money and you believe that gold is an alternative, then you should stick to buying a physical gold.
All this leverage, the volatility, the futures contracts, how you can put down little amounts of capital for all that margin and leverage. I mean, this creates a lot of paper price volatility. It allows for a lot of paper price manipulation. The volatility in the paper price, that scares away a lot of investors, people who can't handle the volatility or who buy basically all of their gold stock position or buy all their metal at once instead of dollar cost averaging or waiting for smashes or premiums to go down.
That's right. And the other thing is that, the futures traders, the bullion bankers, they know where all the key technical levels and where all their clients are leaving the stop loss orders. And they will trigger those, especially, late at night, when people are asleep, when the market's thin. So yeah, it's very hard to be successful as a futures trader, especially if you're not a professional. And most people lose their shirt trying to trade it.
Yeah, I agree. They get away with a lot. They do stop loss blowouts. A lot. The average person doesn't understand the bullion banks and these banks. They get to see the order book. So if you have your stop loss set, they get to see that.
Definitely. I mean, I worked as a futures broker. I didn't really trade much gold futures for my clients, but I had a colleague who uh, I got one of their clients to trade a lot of gold, and yeah, and you can see where the levels are, and people look at the charts, the technical levels, and after you know the late 90s when the exchanges went electronic, that made it easier for the bullion banks and the traders to manipulate things because no one could see who was doing what. It was just on the screen. Prior to that, you were in the pit of an exchange and they could tell, if you try to spoof the market, JP Morgan tried to spoof the market or Goldman Sachs with thousands of contracts being offered, they would lose credibility because if you spoof it, you put the offer in and retract it right away, people are going to say, "What are you doing?" But on the screen, anything can happen. And I think the fact that the futures markets went screen based and every other market, that's helped them manipulate things even more. And the other thing that happened was that these futures exchanges, they used to be owned by, Euro could have gone in the 90s and bought a seat on the CBOT or the COMEX. But unfortunately, what happened, and I think the bankers were behind this, they went to the exchanges and said, "Oh, you should go public, sell your exchanges, do an IPO," and they did. But what this did was that the bankers they owned they now own the exchanges because it probably is BlackRock and Vanguard the biggest shareholders, but I bet you a lot of the banks are behind the ownership of these exchanges. But yeah, so it's a huge huge story, and I mean, very few people know that because they weren't in the business. I know this because I thought about buying a seat on the London International Financial Futures Exchange at one point. And yeah, it could have probably been $50,000 or something. And with a seat on the exchange, it means that you can open your own little brokerage house. But nowadays, that's impossible.
We have some interesting stuff that's happened just in the last 12, 18, 24 months with futures contracts, the CME group. We had the CEO and chairman of the CME group admit on a Tucker Carlson show before it went off Fox News. He admitted he bribes regulators for when he does market manipulation and gets caught, he just pays bribes and no one goes to jail or anything like that. But then also recently, in the last 12 months, we actually did get mid-level managers, I think, people who are teaching the traders how to do market manipulation. I mean, the traders were claiming that they changed their minds for the spoofing, but there's tons of documented evidence of traders colluding with other traders in the discovery process. And I think what the mid-level manager that was teaching the traders how to manipulate the market with the spoofing and the other stuff, he's actually doing some prison time.
Well, yeah, there you go. I mean, I wasn't really trading for my account or my firm's account. We were trading for clients. But yeah, the firms I worked for, if you try to do that kind of stuff, you'd be in trouble. But it seems like, you know, um, in the bullion, and also in treasury futures, I'm sure there's a lot going on, and also with LIBOR. Back in the '08 crisis, it wasn't just the investment banks or the private banks that manipulated things. It was, there is,
Well, there was the LIBOR riggings for listeners who are
yeah,
not aware, because
yeah, it
Mario and I
was,
have been doing this for a long time. I mean, there was a LIBOR rigging scandal, what, in 2010 or
yeah.
11, and there was insane
Well,
amounts of fines.
the BBC, which is the British brainwashing corporation, but even they reported that the Bank of England urged the LIBOR traders to make up the rates in order to keep the market from collapsing. The Bank of England, so the central banks were even, but they didn't get in trouble. I think Barclays got in trouble. But yeah, the central bankers did, and I'm sure the Fed probably was at it as well.
But there's only fines, though. I mean, like, there's not large felony charges and prison times. I mean, I know with the precious metal spoofing cases, there was RICO charges threatened, but I think they were pled down. We do have some of the middle level managers. I think they're going to do he was in on the LBMA too. I think he's going to do what, at 6 months or a year prison time. It's tiny
Yeah.
compared to what they got away with.
Well, the problem is that precious metals, gold and silver, are really important, and most people don't realize it. And I think it goes to the very top, to the central banks, the treasuries, and they need to keep gold under control because it's the anti-dollar. So they're not going to put the big guys in jail. They'll find a few smaller, lower management guys and use them as scapegoat to just tell the public, look, we're doing something about it. But yeah, there's something called the Exchange Stabilization Fund, which I'm sure you're familiar with, and the U.S. Treasury runs that, and the president and the banker for the Treasury is J.P. Morgan. So, JP Morgan, they see that direct line from the treasury flashing. They know, and let's say gold is up $20 or $30. They see that flashing. The traders see that. They say, oh, they're going to come and sell gold. And they'll just probably, go along for the ride. I'm not saying I know this happens, but it's speculation.
Well, actually, the last time the gold price spiked, this was 2011. So when the gold price went from around 900, and then in a couple of years, it went all the way up to 1900 the first time, the European Union officials in Brussels, a lot of the heads of the European Union, the European Central Bank, they were calling the US and talking about intervention in the gold market. Then a year ago, and I was emailing you about this because I definitely want to talk about this, we had one of the former heads of a bullion bank. The guy's name is Peter Hambro, and his family has been in bullion banking and mining and LBMA high ups in the LBMA for a very, very long time. And he made some really interesting comments last summer the summer of 2022. And I'll put the article in the information description section for listeners to read it. It was on Zero Hedge, but he said gold to central bankers is like the son of vampires. And he's talking about how like the Bank of International Settlements and all these central banks in the G7, so like the Federal Reserve Bank, the European Central Bank, they're all Bank of England, they're all colluding to manage the gold price.
Yeah, and Peter Hambro, I mean, his family goes back a few hundred years. They're like, you know, they're not up there with the Rothschilds, but they're quite high up. And he was a bullion dealer in the 70s, so he should know. And yeah, and they've been heavily involved. His son as well, I think, is E.V. Hambro. He's run a couple of gold mining funds for Merrill Lynch in the past. So yeah, it's quite amazing that he came out and he admitted it, because there's a lot of people who think, people like you and me who notice the manipulation, that we're kind of conspiracy theorists. I started noticing it in '02 when I bought my first Krugerrands, because I started following gold on the screen. I mean, I didn't trade it. I just bought the coin. I was trading, government bond futures, but I used to follow the gold price. And I noticed that every day around what time was it? Yeah, around 1:20 p.m. London, which is 8:20 New York time, gold would usually drop. And I was thinking, why is that? And then I found out that the COMEX regular hour trading in New York started at that time, and that the US came in and they usually sold it. And I thought it was amazing, because all the other markets I traded, the markets, they were more random. Gold seems every time, at a certain time, certain things would happen, like on non-farm payroll, for example. It didn't matter what the number was. If it was positive or negative, gold would always be smacked down. Also, after 3 p.m. London, which was the PM gold fixing, and the physical market in LBMA closed, you'd find that COMEX would come in and the futures would drop, always like that. So that's how I noticed it. And yeah, because I'd been, in the markets for over 10 years, and I'd never seen anything trade, like like clockwork, always at the same time you saw the market go down. I thought that's strange.
Did you see the interview that David Lynn just put out with the University of Chicago professor? And she was doing all the statistical reviews of all the things you just mentioned. And she says the evidence was clear that there's paper price manipulation. She said she testified against it and there was government reports about it. But unfortunately, I think the bullion banks only paid a fine for all the profits they made off of. And then there's only a few. It's mostly low-level traders that are getting in trouble. And I think
Yeah.
one
Sorry, go ahead.
No, I was just going to say that, like, relative to the amount of profits that the bullion banks have made, like smashing the derivatives markets when the options are about to expire, managing the price. I mean, they can't, what the average person doesn't understand with the manipulation, in my opinion, is that they can't fully control the price. So there's a tons of people saying, oh, gold's manipulated, it'll never go up. Well, if that were true, they would have capped gold at 1,000, but then there wouldn't be any metal available because the miners would be bankrupt. So there's limits to the manipulation. That's been my
Yeah.
argument for years.
Yeah, and the reason I think they get away with it, why they don't go to jail, because if you and I try to do that, we'd be in jail, is that it goes to the top, as I said. And yes, the bullion banks, they make easy money out of this, but it's not just about the money. I think it's about keeping the gold price under control. But as you said, if there were um, one day they will turn around and go long as well, because like you said, if they keep it suppressed for too long, they'll run out of physical gold unless they shut the market. And yeah, we'd still be at $35 a troy ounce. But it's also, I think the reason for the gold volatility in the derivatives market is to keep the general public away from it as well, to try to keep people in the fiat game.
Exactly. So the other asset classes, so like Bitcoin and stocks, all these other asset classes are all rallying. So even if the economic data in the real economy is bad, inflation's too high, there's bad economic data. The market's like, oh, the Fed's going to cut rates. Oh, QE's coming. Oh, stocks are going to rally, and that's what we're
Yeah.
seeing lately.
Yeah, I mean they want to keep people they want to keep the frogs in the tepid water, and one day, that water is gonna boil and the frogs are gonna die.
I think the important thing that the average person doesn't understand is that we're not telling everyone to put all your money into gold and silver. And this is a mistake I see everywhere, that people start
Yeah.
listening to these YouTube videos that people have been making for many years, and they put all their money at once into gold and silver. No, I mean, like when I buy physical metal, I mean, I'm waiting for the paper price to get smashed and premiums to come down. I'm looking for quality gold stocks. These are profitable businesses that go on sale. I'm not buying all my position at once. And this is the most common mistake I see from a lot of people when they start buying metal.
Well, I started out just buying coins, and you're not really taking your money and buying gold. You're taking your promissory notes and exchanging them for money. That's how I look at it, and you do it whenever you can, and that's all it is. Gold coins or silver coins or bars, they're money that you save. Gold stocks, that's a different thing. That's more investment and I would say a lot of it is speculation. So if I was uh, going to start out now, I would do it just like I did in '02. Start buying a few gold coins. And eventually, I bought silver in '03 the first time. And then eventually I started looking into the miners, and that's a different kettle of fish, the miners and the stock market. But yeah, I see actually gold and silver as money, as a good way to save.
Especially if you just bought and hold fiat currencies, because for almost 15 years, there was zero interest rate policy. They debased the currency. You couldn't earn any interest rates. Now the interest rates are temporarily for short-term US treasuries, I think just under 5%. Although now we're starting to see flow of funds go out of short-term US treasuries. So for many months, they went into US short-term US treasuries. Now they're starting to flow out into stocks or other stuff.
Yeah, and the problem with the, 5% interest rate is not really historically that high. I think the average Bank of England rate in the since 1694 is just above 5%. But the problem we've had is that like you said, they kept rates near zero for 15 years. And now in less than 2 years, they go to five. It's going to create havoc in the asset markets, especially in the bond markets and in banks and other institutions' balance sheets, because those bonds that they hold, they're not going to be priced, at par anymore, because, their coupon might have been one or two, and now yields are at five. So the price has to go down to match, the yield. And that's been the problem.
It's Austrian theory of the business cycle playing out, that the economy and government spending with the debt, it's not going to be able to react to adapt to the high interest rate. So the Fed's, the buyers, as we discussed earlier, there's not the demand for US Treasuries. So the Fed's probably going to have to end up buying a lot of these US Treasuries in the not too distant future. Their balance sheet's going to have to do a 180 and turn around, or they're going to hide it off balance sheet without a Fed audit. But in general, Mario, I think the whole economy, the consumer debt, corporations, governments, there's just too much debt. So even at 5% rates, with the total debt in society the last 15 or 20 years, how much debt has been added, can it really withstand this much, these interest rates?
Yeah, I guess that's the $64,000 question, or we could now call it $64 quadrillion question. Uh, yeah, I agree with you. And I mean, von Mises said in Human Action that once people realize they're not going to stop inflating, they will run away from the currency. That's the danger, the crack up boom. But they only have two options, the central bankers and the governments. They can either keep inflating, and then, we'll end up with a hyperinflation, or they can stop the inflation and we end up with a major deflationary collapse, which would bankrupt everyone. And then gold and silver still do well because there's no counterparty risk in holding physical gold and silver.
I'm not sure they're going to want a full debt deflation where the government, what I know about DC is that they're just not going to be honest and transparent. I mean, there's more and more lies coming out of here from both political parties, from the Federal Reserve Bank, government officials, a lot of the economic data, the Bureau of Labor Statistics for GDP, CPI, jobs reports, they're less and less honest over the years. I just don't see honesty and transparency. And that would be what actually saying that we can't pay back our debt, we're going to default. So I don't think that scenario is going to happen.
Yeah, no, so you're just going to keep seeing more and more debasement of the currency, and it could, potentially lead to a collapse, like a crack boom. Um, Even though they're probably going to do their best to avoid that, and they might use war or pandemics, cyber pandemics, or crises to kind of justify closing the markets or stopping you from doing something so it doesn't show up, and they will blame the Russians or the Chinese, and
Or
but
capitalism. Those
oh
evil
yeah,
greedy
yeah,
Bitcoin buyers or gold buyers. Yeah,
well,
it's all their fault.
even though we don't have really free market capitalism.
Well, they like blaming it because like no one's gonna defend it. So like it's all
Yeah,
capitalism's fault. Yeah, it's like
yeah,
it's the socialists here in the DC metro area on a trust fund
yeah,
that
yeah.
all they talk about is their stock trades and their crypto trades and their luxury travel. It's like all capitalism's fault.
Well, yeah, when they should be blaming the system, the central banking fiat currency system.
The entire thing is so wasteful and corrupt.
That's right.
Well, I enjoyed our discussion. It just sounds like the end, hopefully, is the end of the fiat currency experiment. But I know, like the Davos and World Economic Forum, they want more totalitarian government, more control. They're planning these central bank digital currencies. If you believe in free market and liberty and freedom, you got to diversify out of the system. That might mean physical gold or silver or Bitcoin or real estate, just not trusting the system because if you're holding lots of fiat currencies, I mean, they're intentionally trying to destroy them. And it's not just the US, it's all these governments.
That's right. And the other thing I would say though is, yeah, we might have the physical gold and silver or, even Bitcoin, even though I don't really have much, I don't have Bitcoin, but it doesn't mean it's going to be all, very nice environment, so unfortunately, even for people who have prepared for this, it's going to be tough. So you got to be mentally tough and, batten down the hatches, even if you have gold and silver, even if you've paid off your debts, because, it's going to be ugly out there, I think.
Everything's bipolar now. It's a roller coaster. I mean, the market, all these markets now are just hinging on every single Fed governor speech or risk on, risk off. Things are switching back and forth so quickly now. It's manic depressive.
Yeah. And the trading algorithms are also in charge, and they react to every comment by a Fed official or whoever.
Yeah, I agree. They're actually starting to price in all these Fed rate cuts, but I'm not so sure the Fed's going to cut rates anytime soon. I think something's going to probably have to break first. We're going to have to see another bank failure or a large insurance company or something like that first before the Fed cuts rates.
Yeah, no, I agree with you.
Well, keep up the good work at the Mineko64 YouTube channel. Are you doing anything else besides that these days?
No, I mean that's most of what I do, really. My videos daily, really, on YouTube at Maneko64. I'm on Twitter or X as well. But yeah, that's about it.